Joining me to discuss is Andrew Slimmon, Senior Portfolio Manager at Morgan Stanley Investment Management. Andrew, it's great to see you. Talk me off the cliff.
Well, I think the first thing you got to remember is the market was up nearly 5% last month. So no better that, we need a little bit of the heat to come off the market, a little bit of a fear of a slowdown. But, as much as you could point to things like the jolts that say, oh, the market's slowing, I can point to a bunch of things that suggest, well, maybe that's not happening. I understand a little bit more defensive nature today, but boy, consumer staples, which is people run to if the economy is really slowing, they haven't done very well relative to cyclicals. Dom talked about the bonds, but the yield curve tends to uninvert if the economy is really slowing, and that's not happening. It's actually getting more inverted. So I think there's definitely reasons to not jump into the, oh my gosh, the economy is collapsing or really slowing meaningfully. Although I do concede, we're due for some, rest here, given how strong May was.
Yeah, and I think the point for investors is the market simply priced too rich? You could argue that 21 times for the S&P is too rich no matter what. It's kind of on the bad side of history there. But the idea that aren't earnings going to be vulnerable to some kind of slowdown? And this is where, we talked about this a couple of weeks ago. Is it a nominal GDP slowdown or just a real GDP slowdown? Companies can still earn nominal profits in a high inflation, low growth environment, but maybe that's not a situation that can sustain forever.
I think you're right. I think it's a nominal slowdown. So one of the things that, like just stress testing that thesis, I look at, okay, what happened after Q1 earnings reports? Well, Q1's earnings report cumulatively beat. 2024 cumulative bottoms up estimate went up. 2025 bottoms up estimate went up. And the reason why that's so important, Kelly, is if we're thinking about, well, is the market overpriced? Where is it going to end the year? What's my return from here to year end? Well, you've got to remember at year end, the forward earnings are going to be 2025 earnings. That's gone up. So it's almost at $280 today, and you stick a multiple, maybe 21's too rich. We started the year at 19 and a half, somewhere in that range. I think there's upside. It doesn't mean we can't have pullbacks. I think there's a bigger pullback coming this summer. I think it's too premature, but I still look to earnings estimates. And I guess, the reason I do that, Kelly, is last year was a great lesson for me, which was I kept talking to companies and they'd say, yeah, our business is pretty good, but Wall Street keeps telling us the economy is, going to really slow down or collapse. And boy, oh boy, it was listening to companies. And that's what I'm hearing today. And that's why those earnings estimates haven't really collapsed.
That's it. Because it almost feels to me like this year is the opposite. I'm so glad you put it that way, because it's exactly right. All of us were worried about a slowdown that a lot of companies, we're not so sure. But then look ahead to this year and you look through the beige book and you look at a lot of the sentiment surveys. And again, I know it's election year, maybe that's affecting everything, but it feels like there's this malaise while on Wall Street, everyone's saying, no, everything's fine. And everyone else is like, yeah, we're not so sure.
Right. Well, don't lose sight of the fact that the market had a nasty 2022 and only bottomed a year and a half ago, and that's I think the fact that so much money is poured into the money market because it's yielding 5 to 6%, and that's pretty attractive. Well, that is symptomatic of low expectations for returns in equities. And the only way that money is unleashed from the money market is multiple years of good returns in markets. So, bull markets are born on pessimism. They grow on skepticism. I think we're still in those stages because people still think it's better to invest in money markets than in equities, even though the long-term return of equities has been double, where money market rates are today. To me, it's a sign that sentiment is very, very fragile for investors still.